Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamonds episode number 36 with Joe Mueller on REO Brokerage and buying houses through note purchases. I am Dan Breslin, and on these REI Diamond podcast interviews, I invite world-class guests to share their valuable experience as it relates to real estate investing. You're about to hear real-world experience and advice from Joe on strategies that he used and is using right now in today's market to make money. We're going to cover a few other topics, too, in the conversation. Before I welcome Joe to the show, I want to relate a little bit of a story of how we kind of actually physically met here in the Chicago market and started getting a business relationship together. I am very particular about the people that I choose to work with, and I'm looking to work with a certain type of person, and I do my best to try to coach people along in their business relationships with me. I am sharing this story so that if there's anybody else who's listening in, and they're trying to figure out, the best way to do business with someone like myself or even Joe or any of the people on the podcast, we're very busy, and it's important to approach that relationship a certain way. And it's an attention to detail. It's reading through the entire email. I had related about my process on a previous episode about hiring VAs and even hiring people on Craigslist. So when I'm hiring, there's instructions on how to respond buried in my probably a page to 2 pages worth of text. And if the response instructions are not followed to a T, I don't even consider working with that person. So I had put together a similar ad searching for an investor REO broker record that I could work with exclusively here in the Chicago market, and I posted that on Bigger's Pockets, and I asked for a couple things specifically, and I'm sure Joe remembers answering it specifically. I was trying to duplicate a relationship which I had in another market, so I had a podcast episode of about a 45 to 60-minute timeline, and I wanted the response to include somebody who had listened to that episode so they knew kind of what I was looking for. And I asked for the business model, and Joe replied exactly with his business model. I asked for, I believe, a certain subject line in the email is typically something I'll ask for when I'm looking to work with somebody. And if somebody doesn't read the entire ad, amongst other things, and specifically take the time and put that attention to detail into opening the relationship or determining whether the relationship with me is something they want before just simply firing off a response because they just like the idea of it. That's an indication one way or the other whether this is a person that this relationship is probably 90% successful from that immediate response based on answering all the questions if everything matched up with what I was looking for, versus this relationship is 100% not ever going to work because this person did not even invest 48 seconds to read my 6 paragraphs that I took the time to put together so that we would not have to waste time. And when the right person sees something, they raise their hand. And so that's one of the things that Joe did explicitly when we first met and when we first started getting rolling. So I relate that so that there's like a lesson there. If you're going to respond, this is not necessarily just for me, but if you're going to respond to somebody's advertisement for employment, or you're going to respond to a Craigslist ad, or, in my case, I have other systems for developing brand new wholesalers and brand new investors in the business. And this is cost-free training that I offer that I spent months and months building, writing the book, etc. And there's a method to paying attention to all that. Like I literally buried the link to download my 150-page book. That's buried in a 65-minute audio. So if the person who's listening or gets the email doesn't want to invest that 65 minutes to spend that time. I spent that 60 minutes plus a few days beforehand planning what was going into that audio to make it easy for this person to absorb certain information in certain order. And I'm looking for that person to at least, meet me halfway and invest that 60 minutes. They can listen to the audio. In the audio is the link. That's how they can find out how to download it. And if they've done that, they're going to have a certain perspective on the book when they get it. And if they don't do that and they're just firing off emails back to me, hey, where's that download link? I don't even respond to them with the download link. The download link instructions are clearly specified in all the other previous communications that I send out. So that said, I'd like to welcome Joe onto the show. Welcome to the show, Joe.
Thanks, Dan. It's great to be here.
Yes, sir. And do you remember specifically responding to that ad? I mean, let me ask you that question because we haven't talked about that prior. Did you specifically answer that ad so clearly? I mean, you obviously had read the whole ad. Tell me your perspective from somebody who found that and replied to the ad, and then now we're getting into a working relationship together.
Yeah, I do remember responding to the ad, and I'm of similar belief to you where, you lay out the instructions and people can follow them, and you have to read the entire, we'll call it email, or in this case it was an ad, and respond as directed in order to kind of make that contact, because I understand how, the most valuable asset for a lot of people, especially investors, is time. You need to clarify exactly what you're looking for and answer them correctly. And just to segue on that fact, in the REO business, we have very specific instructions that go along with a lot of the properties that we sell. And a large number of the buyers and the other brokers I work with, are not necessarily reading the entire email or the instructions. And that's what creates some of the conflicts with getting an REO from, a contract to a closing table, because the brokers themselves don't take the 2 minutes to read an email in its entirety.
I'm going to ask you a real quick one, and then I want to know exactly how you got started and got to the REO spot. But what percentage, I know you don't have the exact percentage, but what percentage of people would you say, from your observation in these REO deals, don't read the email versus those that are diligent and pay attention to every detail and get the instructions right? I mean, are we talking 50-50, or is it like 10-90? Or
I would say 80 to 90% are not following the instructions correctly. And that's what results in conflicts and challenges and getting contracts accepted through a bank, because they just simply haven't taken the time to sit down and thoroughly read and digest what we need in order to get their offer accepted or their property to a closing table, which is what's best for everyone. And it's a constant challenge in my side of the business. My staff is always on hand to assist, and it creates a lot of frustration on the buyer side because they're just not consistently reading what we tell them to do, which is basically the play-by-play, A, B, C to D, to get this property acquired. We try to educate as much as we can in the process. We actually do hold meetings with other brokers to teach them the process so they understand, because I can totally get it that a broker that's only done a handful of deals that, maybe has an investor or has a buyer that wants to move into a HUD property or an REO house, they haven't done it before. So we consistently are teaching on a monthly basis on exactly what needs to be done and help them understand the process. So there is no frustration and there is no challenges. We try to make it as streamlined as possible for them. But yeah, to answer your question, I would say 80 to 90% are doing exactly what you brought up at the first part of the podcast, which is they read the email, they read it very quickly, and they respond very, very quickly back without even thoroughly understanding what they're supposed to be doing.
This is great. This is a great illustration, Joe. I mean, I'm amazed that it's 80, 90%. And then on the flip side, I'm not amazed, because this is one of the illustrations where people kind of think success happens by accident. Like, this guy got lucky and that's why he's doing 10 deals a month. Whereas on the flip side, there's the same 5-10% of people that are like highest success level and highest incomes in just about any field are those that were paying attention and, following all the instructions and making sure to be completely present in their job or whatever their profession or whatever their investing career is. So that's a great illustration of that story that you just mentioned. So, Joe,
Sure.
We got an idea. You're in the REO business. Why don't we start kind of from the beginning, how you got started, maybe, just the quick version of how your career developed, and then a present tense, what your business and what your investment activities look like today.
I actually got started both in investing and segued into REO by investigating and buying property at the sheriff's sales in Kane and McHenry and Cook counties of Illinois. Back when I was in my late teens, I had a very strong interest in real estate, and at the time, the market was about to start the upswing in the early 2000s, so I saw an opportunity to potentially, educate myself in that niche of going to auctions and sheriff sales. I ended up borrowing some money, some private money, I bought my first house at the auction block when I was 19. Through that process, I was kind of self-educating on how to search for liens on title, how to make sure there wasn't any tax issues that would come back and kind of bite me in the butt, and ended up buying quite a few houses that way when I was first getting started. And the challenge I had, because this was pre-Zillow or pre some of the internet capabilities that are out there right now to value properties, is I only had, classified ads and my own two eyes to kind of drive neighborhoods and check out values on properties. So I ended up getting my license. Worked for a franchise for about a year, and in that 1-year process, I got my broker's license, and I licensed my company, which at the time was the entity I was using to buy properties at the auction block, as a brokerage itself. And as I continued to work that auction block niche, I started meeting banks that were showing up to bid on their second liens on the properties that were going up for auction, because they're essentially going to lose their interest. Should the first lien sell out to an investor, they would lose their, we'll call it $50,000 second mortgage. I met a guy out of Ohio who asked me some questions about a particular property. We ended up discussing it further after the auction and ended up having lunch. And it turns out he ended up being my first REO client when I was probably 21 or 22, and gave me my first listing because, we had met a few times. He had flown out to the auction because they had a portfolio that, was, I guess, in bad shape. So over the course of a few months, we developed a relationship and started with one REO, just built off that same type of knowledge and built those relationships up to the point where I think right now we're working somewhere between 20 and 30 institutional clients, including Freddie Mac, Fannie Mae, and HUD, in addition to a lot of small local banks and some, national banks as well. Right
Nice.
now we have approximately 150 to 175 active listings that are on the MLS. We've got another 200 or so that are in the hopper, that are essentially in the pre-market status for me, which are properties that are in the foreclosure process that we're actively managing, monitoring, talking to the current occupant on behalf of the bank for discussing options with, making sure that the properties are preserved should somebody vacate. Right now, obviously in Chicago, we're in a warm December right now, but typically at this point you're seeing temperatures in the 20s and 30s. So, we handle everything from the day that somebody defaults on their mortgage all the way through foreclosure to the point where it's actually sold to another end buyer, which most of the time is easily a 6 to 18-month process, depending on the bank and depending on if there's any conflicts with the mortgage itself. Should an owner-occupant, try to fight the bank in some aspect to stay in their home.
Got it. So what comprises your business today? Because I know you do some other activities other than just, we have how many agents there, Joe?
We have 16 brokers right now, including myself. Yeah, we do. My company runs about approximately 400 sales per year, and I would say 90% of those are somehow related to REO or investors. The brokers that work for me that are the most successful are also taking advantage of that opportunity by selling these properties that are essentially sold at a discount or create some type of value add opportunity. In addition to the REO brokerage side, we're actively working with investors. I have, a lot of experience at this point building rental portfolios, including my own, which is about 50 rentals that I currently hold right now, helping some other investors get started from sometimes 1 or 2 properties all the way to 20 or 30 properties we've had experience with.
Okay, you do some fix and flip also, don't you, Joe?
Yeah, I'll do a couple a year, 1 to 2 per year. It's not my personal main focus.
All right.
The first thing is I can't buy from any of the banks that I work for. So if I'm working for Freddie Mac or a Fannie Mae or a HUD or U.S. Bank, whoever it may be, I cannot purchase those properties. And a lot of times I can't even purchase any of their inventory, even if it's listed through another broker, because it's just some of the conflicts that they see that they won't allow me to do that. So I'm constantly looking for new ways to, find properties and acquire properties. It's led to a pretty good stream of wholesaler contacts that I work with, other investors that are either in that niche itself where they're maybe dumping off a few properties that they currently don't have an interest in owning anymore. When I find a property, I evaluate it, figure out if it's going to be best for, my rental portfolio, if it would be something that maybe another investor would be interested in. And then I would say it's probably third on my list is how I could take advantage of it as a flip. Because I think that, the best way to create wealth is through buying and holding real estate, not necessarily flipping, which, as I've heard many times before, you're essentially creating your own 9-to-5 job by constantly needing an inventory, fixing up property, and then flipping it, and it'll pay you for a month or two, but then you got to go right back to work and start all over.
Yeah, I totally am agreeing with you. I've had another gentleman who I should probably have on this show. He told me, he said, Dan, you're eating your portfolio every month. You're out here wholesaling and you're fixing and flipping and you're just eating your own portfolio. And I'm like, God, the way he described it, and like his face was contorted as he said, like as if I was a cannibal.
Right, sure.
And
it's starting
to figure out, like, even for myself, I'm doing a lot of these deals, and probably the same way you're doing a lot of deals. You're doing 400 deals. There's brokers that are making money, everyone on your team, and I have a very similar philosophy to that myself with the wholesale component of my business, and then I also fix and flip houses. But so my goal, or I guess my income that I live on, that I pay my bills with, my income is mostly derived from that, from, $2,000, $3,000, $5,000 assignments that are cut up several ways, pretty much the size of commissions, a lot of our deals. And I'm watching other people who are buying these properties that I wholesaled maybe 4 or 5 years ago. They're renovated, they've collected rents for 3 years, and they did a refinance and took 100% of their money out. And the $1,700 an assignment that I got back in 2012 is long since gone.
Right.
And then on the flip side, I also have some sort of buy and hold properties. We're in the group home business in the Philadelphia market, so we either buy or lease, depending on the structure, depending on the property, a house, and then we run a group home there for drug addicts and alcoholics who are coming home from rehab and things like that. And all of a sudden, we're starting to see that monthly cash flow is building, and it's becoming something substantial, and I'm experiencing that in my own life, the ability, although $400 a month doesn't seem like much on a rental, or $300 a month positive cash flow doesn't seem like much when I can assign a deal and make, $7,000 on it, let's say. But over time, I mean, if you get to a number like 40 or 50 or even 10 or 20, there's, it's more than a car payment there. It's more than your own mortgage payment for your house. Joe, do you self-manage those rentals, or have you built a property management company, or do you outsource that component of your business for rental properties?
That's a great question, and I have a perplexing answer. Yes, I handle I handle property management for other investors. We do it fairly locally in the suburbs of Chicago, as well as down in the south. So I should say that a little differently. Northwest suburbs of Chicago, I personally handle management for about 15 investors right now. And then we also have a component down in the south suburbs for a turnkey investment business that I started actually earlier this year, where we're managing properties in the south suburbs that we've essentially acquired through various methods, but tax sales and knocking on doors, acquiring for very low acquisition costs up front, fixing property, and then tenanting them and selling to other investors. I also do use another management company on occasion for a handful of properties. I guess the best answer I have for that is, even though I manage myself, I manage a lot of my own assets myself, I also still want to kind of keep in the game with what other management companies are doing, see what the competition is up to, see what systems they're utilizing. It's good to have a backup plan is the way I saw it. So for some reason I need to, be out of town for a week or two and something comes up, I've got this management company that I also work with that I can kind of utilize as a backup plan should something happen or should something need attention. So I believe in the fact that, you got to create relationships, and I've actually got a pretty good one with this management company. We often trade business back and forth as a result. Some things work for them that don't work for me. Some things work for me that don't work for them.
Got it. So as an investor myself, and as an investor who is becoming more mature in my mindset as far as approaching some buy and holds, and obviously I have some cash that would need to be put into some buy and holds and some places to make money. I'm getting to that point in my own career. I am thinking to myself, wow, Joe's brokerage here, this is the kind of guy, if anyone's listening from around the country, this is the kind of guy that, quote unquote, an investor-friendly agent, would an investor-friendly broker would kind of have all these facets in-house. So we have REO inventory, not 3 or 4 listings, not, obviously you could sell other people's listings, but it's not, you have the relationships with the bank. You have the component for management depending on which area this is in. So if somebody's in northwest suburbs, or you find somebody similar to Joe around the country who can have very similar thought processes and systems in place and teams in place, I mean, is it likely, Joe, say a guy like myself who's an hour and a half away from where you're at, could I potentially buy, say, an REO property in your area, and then I'd have to get the renovation done somehow, but then have your property manager, obviously you could handle the management. Would you also have any construction components there for clients like me that I just described?
Absolutely. We do that quite regularly where we're assisting in the management of the actual repair process or rehab process. I've got some contractors that are, that I've worked with for a large number of years. Some of them are more closely related to my company where they're handling not only my own investments, but also working on the REO properties. Their interest in working with me is the fact that they're getting a volume business where they can kind of feed their family just off of what I can provide on multiple levels. So to answer your question, absolutely, we can put together scopes of work for properties before an investor even, physically sees the property. We can take that from start to finish as far as getting bids and, creating the best rehab for whatever that exit strategy is of that investor. I would say typically we're seeing that more on the rent and hold side as opposed to like a fix and flip. I don't have any clients right now that are working fix and flips remotely where I'm managing the contractors as well. It's typically done just on the buy and hold side. And that's just all part of the process, kind of a full service investor brokerage is what I wanted to offer. So yeah, we have contractors that are, better suited for lower end repair, and we've got some guys that are better suited for higher end repair depending on what the investor's looking for and what the market, demands, I should say.
Okay, so as a client then, I could pick the phone up and I could call one shop, you guys, and I could get the property. Obviously, you would know what the rent was going to be because you have other properties under management in the same neighborhood, right, Joe?
Correct, yep.
And then you could give me a scope of work. Is that something you'd be willing to do before I submitted my offer to the bank?
Yeah, it depends on the investor. Typically we're going to be better suited for somebody who is understands the processes, has their goals aligned with, the types of realistic outcomes that we're going to see depending on what the area is. And when I say that, I mean it's unrealistic to rehab a house that, needs $30,000 or $40,000 in work and rent it out at a good price unless you got it at the acquisition side was extremely beneficial when you picked it up. So, some of the clients that we've had the most success with are guys that have ramped up business from a handful of properties and got themselves into the teens or the 20 to 30 property mark, where they understand what, our goals are aligned as far as what the expectations are with the contractors and what that end rehab is going to be. At one point, I started that in-house a few years back because we were working with a hedge fund out of California that actually purchased approximately 200 properties through my brokerage, and we had a full-time staff of 3 that I ended up hiring that basically managed that every aspect of that account, we'll call it. So initial inspections all the way through the rehab process up into the point where we're managing or renting to a tenant, and then essentially turning that property back over to the hedge fund saying, okay, this process is complete. They did have a third-party staff as well that kind of was part of the process, checking up on things, but it was like working as a team to get that common goal met. We definitely have the opportunities to help an investor get started as far as maybe pick up their first 1 or 2 properties. It's going to be a situation that is not going to be overnight success because we want to make sure that they're educated, they understand the market that they're in, they understand what cash flow is going to be like, what their financing options are, and then we've obviously put together situations and processes to handle large volume acquisition, rehab, and hold as well.
All right, let's talk about let's go into some detail, I guess, about kind of your expectations of what the investor brings to the table. And what I mean by that, Joe, is, if you're on Bigger Pockets or you've just stumbled upon real estate somehow, there's some people think that this is like the no money down and, you don't need any money and you could just you don't even need a job or income. What realistic cash reserve requirements, what realistic yearly income, what realistic credit, and what realistic refinance back out of cash could someone expect? And what I mean by that too is, like, if I was to buy a property, I don't know what the numbers are, but if I bought it for $35,000 and we put $35,000 into it, is that something that I could refinance and get my $70,000 or maybe $65,000 out of, Joe? And if you could just kind of like go through, this guy had to make or gal company had to make $100,000 a year to be like an ideal client. If we could just go through like the qualifications of that ideal customer so that someone doesn't reach out, or maybe like what I'm trying to say is, what should a person who maybe doesn't have everything like that in place, what goals and targets do they need to have in place in order to approach a company like yours?
You know what, that's a great question, and it's a complicated answer, but to simplify it, I would say having some source of income is going to overcome 90% of the challenges as far as a financing situation or a refinance situation. Related to your specific example, yes, acquiring a property at $35,000 and putting $35,000 into it on the rehab, assuming that the after repaired value is, $100,000, $120,000, $150,000 would be the goals we'd be shooting for. You shouldn't have a problem refinancing out not only your initial investment, but also that rehab cost of total cost of $70,000. I mean, typically we have a couple lending, quote unquote, partners that we recommend working with. It's all commercial financing, and they're looking at 70 to 80% cash out refinances on 3 to 5 year balloons as far as the commercial loan goes at today's rate. So no points, no extra fees. I know there's a lot going on out there right now in the financing world, including with crowdfunding and some of the new regulations that are coming out from the SEC next year. But we're trying to guide the investor from start to finish on here's what the realistic expectation is. Your specific example would be something that I have seen in the past. Typically, I'm not seeing much property able to be purchased at that low of a price in my area, though there are some opportunities that come up. If it makes it to the MLS, those are situations where you're going to have multiple offers and a lot of investors actually paying more than what the list price would be. So we kind of specialize in working on, these investment opportunities. So I would say a good piece of advice for, these listeners is if you're working with a seasoned investor-related broker like me, if I tell you to offer $50,000 on a $35,000 house, that's because you need to do that if you really want the house. We've had many situations where I even had a house, I think it was about a year ago down in Aurora, I found for an investor. It was listed at $65,000. We got the offer accepted at $150,000.
Wow.
Sounds kind of crazy. That's a rarity as far as going up, $90,000 above purchase price. But the realistic situation was there was, $120,000 in equity in that property after it was acquired at $150,000. So just because it's got a price on the MLS doesn't mean that's what you should be buying it for, I guess. As far as working with investors and, back to the original question about income, the banks that I work with are often very, very complimentary of the fact that we're working with not only seasoned investors that are full-time, but they also have income coming in from multiple sources. So whether it's some form of rental income at a couple $1,000s a month. They're also actively flipping, let's say. They have the 1099 income coming in through their own investing. We've had success getting refinanced and using financing for acquisition on that side, as well as, we'll call it more of the beginning investor who may still be working a 9-to-5 job, for example. It just makes it that much easier. So can somebody start with nothing? Sure. Are there lending opportunities out there where, as you know, there's hard money, there's some credit line opportunities out there right now where you could effectively get $100,000 in, acquisition money through credit lines. I would say that it's always going to be easier if you've got some income coming in, though. And when we strategize, that's why it kind of comes down to specific goals and expectations on both sides of the fence between the investor and myself. What do you see? What do you see your end goal being? How many properties do you want to purchase by the end of the year? What are your financial capabilities of doing that? Because it is a process that's not, even though we can simplify it as much as possible and we have the experience and the knowledge, that we still have to sit down and make sure that investor understands, what steps that's going to take to get to that point. And that they have a realistic set of goals and expectations so we don't end up wasting anyone's time.
That makes sense. So, Joe, you mentioned this listing for 65 that sold for 150,000. Is that like did somebody make a colossal mistake on the listing price, or is that like a strategy that some agents use to get a flurry of activity and then bid up the price that high?
The real answer was the backstory was related to an estate sale, death in the family. There was a couple of the surviving children that were looking to move out of state with this, we'll call it the 65,000. They needed to do that, so they listed at the price that they wanted. That was their reserve price, we'll call it. That's exactly what they needed to move on with their lives. In that particular case, we had an investor that is very savvy with the Aurora market. His plan was to hold that property as a rental. I can't remember the rental income specifically that it was going to rent for when he acquired it, but I do recall that it was a very good property. It had needed very minimal work. And, if I remember correctly, we were one of 15 buyers that were bidding on the property. We were the highest by only a few $1,000s. Somebody else actually offered in the 140 range because that was what the property was worth and still allowed, a really sizable equity spread. Maybe it was poor education on the side of the listing broker to the family members that were settling the estate as far as the value. Maybe they used a family friend, that didn't really know the market. I can't answer specifically because I was on the buy side on that one, but that's something I don't regularly see. As far as what I do see is a lot of times there are these banks out there that have acquired portfolios of properties, or they're trying to sell off larger numbers of volume of whatever they have in their inventory. And even though we will tell them specifically, hey, this house may need $50,000 worth of work because it's got mold and water damage and there's a hole in the roof, you should be listing this house at, let's say, $100,000 because it's a $200,000 house once it's repaired. They'll still go ahead and just put a rock bottom price on it of, let's say, $69,000 to $75,000 or $80,000. So 20 to 30 under market from what we're telling them the as-is value is. Almost, ironically, the pricing that it sells for is right around those ranges that we're seeing the as-is value. So there are opportunities out there to pick up properties at very strong discounts, but you got to be ready to pay what the property's worth and still have that profit margin or that equity spread in there so you can meet your goals, which again are going to vary depending on who that investor is.
Let's talk about the turnkey rental business a little bit. A lot of the guests I've had on the show previously are in the turnkey business in one function or another. Philadelphia market, we had a guy from the Indiana market, and now you guys are starting into that. Could you tell me what drove that decision to move into that space and kind of how you guys are providing that value to win there?
Absolutely. Well, through the last 15 years or so being a broker and just working in the investment space, the simple answer is the biggest challenges come from the acquisition and the repair side of owning an investment property. Getting it from an uninhabitable condition to a point where a tenant can, get handed a key and move into a nice house with new cabinets and counters and appliances that are all functional is obviously worth that work that goes into it as far as an individual investor. But I saw some opportunities in the fact that, the turnkey business is it's a hot button right now in the investment world. In the Chicago area itself, there's not a lot of neighborhoods that are not only good areas that do offer, some appreciation aspect over time for a lower end acquisition price. So the market I'm working in is down in the south suburbs. I took on a partner for another new business. So we're focused down in the Sauk Village, Country Club Hills, Chicago Heights type areas. We're able to pick up properties in the ranges for as low as $1,500 direct from a seller, all the way up to, I think the most we've paid at this point is about $30,000 for a property. We're repairing the properties, bringing them up to a condition that we feel is adapted for, tenants. So we're not using any carpeting. We're using, high quality paint, cabinets, fixtures, things like that can kind of stand the test of time and turnover from tenants. We're ending up selling these properties to other investors for anywhere from $40,000 to $75,000, which is realistically what their value is after they've been repaired. In those numbers, the key is that we're focusing on certain communities that have lower tax basis. So Illinois is synonymous for high taxes compared to Indiana and Milwaukee, where I also own some property. Your typical tax bill is anywhere from $2,000 to $4,000 on a 3-bedroom, 1-bath ranch, almost anywhere throughout the Chicagoland area. We're focusing on areas that have that lower end, so $2,000 to $2,700 a year for taxes, which creates a situation where an investor can come in, purchase with cash or with financing, 20% down, for example, and they're still cash flowing $400 to $500 a month with a property that's basically been rehabbed, top to bottom, depending on, the condition that we, acquired it and how much work we need to put into it. We're looking at anything that has a lifespan of 10 years or more left in it. For example, a roof or a furnace. We're not going to replace a roof that's good for another 10 years, but if it's starting to curl and we see problems, then obviously we take care of, the things that are going to be long-term costs, capital expenditures for an investor. And the goal being to create a situation where we have return business and volume as a result. So they trust the fact that we're, they see the quality of work. They can be part of the everyday process as far as if they want to visit the properties on a semi-regular basis. We allow that to happen in an open house style format where we're meeting with investors every few weeks and showing them the status of the properties and what we've got in inventory and, how that work takes place and the quality at the end. And I think that results in, a high quality product that they can depend on us when I tell them, yeah, this is what we did and here's the before photos, here's the after photos, here's the lease, here's the background check on the tenant itself. Here's the income information about the tenant. Here's the previous landlord contact. I mean, everything from vetting the property all the way to vetting that new tenant, we're very hands-on with, because those are all the problems that come up when you're a real estate investor. And I get that everybody tries to minimize expenses. I mean, that's just the name of the game in real estate, is save money and make money, But the real hard facts are that a lot of investors put thousands and thousands of dollars into rehabbing a property, and then they turn it over to a management company who rents it out to somebody that they end up evicting 6 to 9 months later because they didn't vet the tenant up front. I ended up getting a debt collection license, which that's a story for later in the podcast, but as a result, it kind of gives me access to software that's out there for skip tracing. So we're able to vet each tenant, all the way down to the point where we're actually doing on-site visits of their current residence that they're living in, talking to their landlord. We're asking for proof of income. We're asking for proof that the rent was paid to their previous landlord. whether it be a money order or a Chase Quick Pay or however it is that they paid, we require all those aspects. And if they fail at any one or they refuse to let us, view their current residence that they're renting, then we don't rent to them. It does create a longer process for actually acquiring a tenant, but we're signing up tenants that have 2 to 3 year leases, and they're staying in the properties, they're taking care of them, and it's just doing that due diligence up front that, results in, better long-term success for not only the investor, but also my company, my reputation. And anybody who's been involved in owning rentals knows that the biggest problem is your turnover. So keeping a tenant in a property as long as possible is what creates the most profit for an investor, because every time a tenant leaves, you're essentially out 1 month worth of rent at minimum, plus whatever repairs you may have to do to just, cosmetically bring that property back up to par, assuming they didn't destroy it. My partner down there he owns about 20 rentals on his own. He's very particular about working with the right contractors and the right investors and tenants as far as just making the system work.
And Joe, these properties in this area, $40,000 to $75,000 sale price, are these the kind of deals that I could buy with cash and refinance and get my money or most of my money back out of? Is there any even if it's not a equity position where I'd be able to sell the property, is there an appraisal equity position in these properties?
We typically try to sell the properties for $10,000 under what we believe their appraised value is. So we try to build in some equity up front for the investor, just another perk as far as working with me on these properties. It is something that you can acquire for cash and then refinance out of. You're going to have to, depending on which bank you work with, and again, we have some lenders we can recommend, but there's always going to be some form of a seasoning period between the time you purchased it and, sometimes it's 30 days, sometimes it's 6 months or a year, depending on which institution, you decide to work with to get your cash back out. I would say right now we're typically seeing cash purchases. We have had one purchase in the last month or so, probably about 6 weeks ago. We sold one property to an investor who used financing. He put 20% down. I mean, the numbers work fantastically, so there's never an issue with financing, but based on the lower acquisition price for the investor, most of our clients have been paying cash, and then their long-term plans have been to acquire as many properties from us as they can, and then refinance out on a blanket commercial loan or blanket mortgage, I guess would be more the verbiage that I guess the audience will understand. So maybe put 5 houses under one note. You got to keep in mind we'll call it a $60,000 acquisition price. If you did finance up front on a $40,000, you put 20% down, so that leaves you a note at $48,000 because a $12,000 down payment. Just running numbers off the top of my head. Now you're looking at a payment somewhere in the $200 per month range, give or take, $50 because I'm not a mathematician. But taxes of another $200 to $300 a month, and something that's rented for, $1,200 to $1,400 are basic rental numbers. Cook County just commands, higher rents in general. You've got a good cash flow spread every month, even just buying one property for a $12,000 investment. I mean, you're getting your return back within a year.
Yeah, that's mind-blowing.
It's good stuff. I mean, it's a lot of work. Like I said, I've got a partner down there. He kind of handles more of the day-to-day, boots-on-the-ground activities, and I'm kind of strategizing behind the scenes and working on the funding side and keeping the business model moving forward and building the client base, things like that.
How long has this business been running, and how many are you doing or have you done? What kind of a place are you guys at so far?
Well, I met my partner this year in Indianapolis at the Mr. Landlord Conference, which I believe was in March of 2015. I had been looking for somebody to work with on a turnkey level for quite some time, and he had the experience that I thought was needed, and we just hit it off as far as investors and became fast friends. So we had our business up and running by, I believe it was June of 2015. Right now we're sitting on about 12 properties that we have rehabbed or are finalizing the rehab process, and we've sold about another dozen to other investors, most of them buying multiple properties at once, but a handful of investors that have just kind of organically become involved with us. I haven't done any marketing. I haven't really put my feelers out there to try to draw in a new buyer base. Just been through word of mouth, and because the numbers work, investors know investors. So we get phone calls pretty frequently, or I get phone calls pretty frequently from people that are interested. We honestly kind of have a little bit of a backlog of buyers that want to pick up these properties. The initial goal was to just turn them and create a situation where we'd have a consistent cash flow from selling them regularly. And after seeing how some of these numbers work, out of those 12, we're holding on to a little more than a handful with the intention not to sell because the numbers are fantastic. And, I have a hard time selling real estate when it's making me money every month. So we're still actively acquiring and fixing. Our acquisition methods are pretty unique as far as working with tax deeds and tax deed buyers that end up selling us the property after they've gotten a deed from, the county. We've been fairly successful at that. We've done some door knocking as far as vacant homes, seeking out the owner. All the stuff that you learn as you educate yourself in real estate investing, and you kind of think to yourself, well, yeah, that could probably work. I'm always trying to think outside the box. So if we find a property that has grass that's 3 feet tall and obviously hasn't been lived in for a year and is off the MLS, so it's not on the market, I start doing my background research, try to figure out who owns it, how we can get a hold of them, try to find phone numbers. And with, social media and Google, there's so many opportunities right now to kind of get this information, and we talk to them about what their situation is and what they need as far as maybe selling the property and try to work out a deal. So we've been fairly successful at the acquisition side that way. In addition to buying, we bought a small portfolio from another investor earlier, probably right when we got started back in the summertime, that came to us through a wholesaler, sold us 4 or 5 properties up front for a pretty low price because he just had to get out. So looking at all aspects of it, right now we're looking at trying to build a personal portfolio in this area of roughly 30 properties, which we estimate will bring in $10,000 a month each for my partner and I. And once we have that, we're going to continue to focus on fixing them and selling them to other investors at the same time. But it's kind of one of the situations where we're doing one for me, one for you, one for me, one for you, because the numbers are just fantastic.
Is the inventory, the lack of scalability there? It sounds like that might be the only bottleneck in that business model. Would be where do you get another 25 houses from?
There's quite a bit of inventory, down there, and we're looking at expanding into other or other communities in the surrounding areas, depending on what their taxes look like. But yeah, I think in any situation, minus 2010 through 12 in Illinois, where there was plentiful inventory. Yeah, we kind of have, it ebbs and flows is the good answer. There'll be a week where we have 3 or 4 opportunities sitting on my desk, and then there'll be 2 or 3 weeks where we don't see anything that even looks like it's worth, inspecting on our end. But I think ultimately it's going to be a situation where we continue to grow and study the markets surrounding the communities we're currently buying in to meet the demand of what we need and then any investors that choose to work with us.
Got it. So let's talk about that debt collection license. You had referenced that, and it sounded like an interesting place to go.
Well, that's going to cause a situation where we're talking about non-performing notes. Again, as I said earlier, I'm always looking for unique ways to acquire property. I do believe there's opportunities on the MLS, but there's also a plentiful opportunities off the MLS. And through my experience with working the REO side, I basically handle everything from the point somebody defaults on their mortgage. And when I say handle, I'm the boots on the ground, inspecting the houses, talking to the occupants, verifying if they're an owner, if they're a tenant, all the legal requirements that the banks need to move forward with a foreclosure. Once that property becomes vacant, I am rekeying it if that's where we're at in the process. I'm winterizing it to protect it from freezing. We're boarding windows that may be broken, making sure the houses are secure. I guess the important aspect of that is, though I'm getting direction from, a bank, I'm still the one doing all the footwork, and including deed in lieu of foreclosures, where I'm meeting with homeowners that no longer want their property and they're deeding it back to the bank, cash for keys, or, a situation where we're trying to help them move on to a new place, so the bank will offer them, sometimes $1,500, sometimes $6,500. It just depends on the bank and depends on the area that the property is located in. So that kind of caused me to realize, like, hey, I pretty much know all parts of this business other than what happens before when there's actually a mortgage originated and somebody defaults, essentially. That brought me to educating myself in the non-performing note space. I, again, kind of went through some personal education. I'm a big reader. I read 2 to 3 books at a time, at one time, depending on my mood. And I was educating myself in the note space, which I found there's a lot out there on the internet, but there's not a lot out there in like the literature world as far as, what is this business really about? So I started going to conferences. I started networking with people that are actually note buyers. I started talking to guys on Bigger Pockets, guys and gals. I quickly realized that there was some opportunity in buying these non-performing notes for a discounted price, eliminating a lot of competition because it's off the MLS, and, picking up multiple properties or multiple notes at once, which created a better discount if I would buy 3 or 4 as opposed to just one from the same note holder, let's say. The debt collection license came up because I'm using a servicer out of California who's essentially the quote-unquote legal entity that is sending the correct mailings and letters to, let's say, an owner-occupant whose house is currently in foreclosure. You have to use a servicer in this process when you are an individual note owner like myself. They actually recommended I get my debt collection license not only for increasing my knowledge, but just the credibility of, working with other sellers of notes and banks and things like that. It was a fairly simple process. Took me a few months to get it, but a little bit of out-of-pocket expense, but there is no education requirement, and that basically opened up some more doors with the aspects of, research, and I brought up before skip tracing, because as part of that debt collection, you can research whoever owes you that debt, for example, or depending on what the purpose is, you can do background checks on tenants and things like that. So to me, it was a natural fit to get into the non-performing note business. Up to this point, I've pretty much just utilized it for my own investing. I haven't really tried to sell a note to anyone else or market that experience out there to investors, but I feel that having that knowledge is obviously valuable, and I've been successful with buying some ending up, I should say, because you're not buying a property, you're buying a note, but I've had to do deed in lieu on property. I have had to take, I believe, one through a full foreclosure, and then ended up having to evict the previous occupant. But again, all at a price that I was very happy with on the acquisition side. The key to success in the note business is time. It is not something that is typically very quick. You don't buy a note and then 2 weeks later you're sitting at you're at a closing and you come up with the money and then you get keys to a property. I mean, I've sat on some of these notes for quite some time, 6, 8, 12 months, depending on where they're at in the foreclosure process. But the end goal really is to create a situation that the owner of that property is happy with, whether it be they do want to move on, or if there's a way to keep them in the property, or they can restructure, if we can restructure that note and keep them in their home, assuming they're capable of actually paying the mortgage, whether it's, maybe I reduce the monthly amount that they owe and tax them onto the back end. I mean, that's what's really cool about the note business is it's pretty much, you're kind of the commander of your own world as far as how you can negotiate and restructure things and ultimately create more value. A note that you buy at, let's say, 50 to 60% of the property's value, you can, invest $50,000 in the purchase and then restructure it with that occupant, to make them reperforming again. And that has value on the open market in the note world. So you can take that note and then resell it to another note investor for maybe $70,000, because after 6 months, it's considered a seasoned note that's been reperforming. and you have your backup documentation showing they're making an income, they're making their payments, here's where they work, et cetera. It's a very interesting business, and I'm still scratching the surface, but, you know, the way I operate is I kind of dive head first into things. So I had to do it myself before I could, you know, really understand it and speak about it. I've had several occasions that I've bought notes for lower dollar amounts in Chicago as well as the south suburbs, and I've been able to find that the properties were completely vacant, essentially abandoned. One of them, the foreclosure process had already been vacated, so there wasn't even an active foreclosure when I bought one of these properties, which is kind of a problem in the note world because I'd have to restart that and, you know, go through that 1 to 3 year process depending on the county. But going in, utilizing social media, I found one of the owners on LinkedIn and contacted him. He was another investor who fell onto hard times during the downturn, and he was ecstatic to sign over a deed in lieu, get that property out of his name, stop getting bills, tax bills, code violations, and, you know, he put some money in his pocket because I paid him, obviously, for, you know, him turning the property over back to me, and that eliminated my headache, my cost of going through an actual foreclosure, and everybody was happy. Similar situation on another asset that I acquired earlier this year. I found the owner on Facebook and contacted her through email. She also was an investor. It was her second. She had 2 houses, one she lived in, and then there was a second house that had been basically, the roof was caving in. I mean, it was in really bad shape, but I was able to pick up the note for $5,000 on something that I determined was a $25,000 to $35,000 property. I ended up doing a deed in lieu with her as well. Again, very happy, ecstatic. I gave her $1,000 to sign over the deed, and everyone won in that situation. So I ended up selling that property to a third investor who fixed it up and now has it as a rental in his portfolio.
I also had, just as a side note there, I want to plug Dave Van Horn was on this show previously, so if you're interested in some more information on non-performing notes, not to go after the property, but Dave's specialty is to get those non-performing notes re-performing again. You can check out his episode, and I'll make sure to put that link in with the show notes here. So, Joe, you talked about with the non-performing notes, you had gotten some firsthand experience with the banks by going and boarding up the property and seeing if it's vacant and doing these inspection reports for all of your REO client inventory. Is there a possibility that me, as your client, could come to you, who maybe was doing some of this inspection and pre-foreclosure type work for certain bank clients of yours, and because I'm a separate client outside, I'd be able to maybe make an offer to purchase that non-performing note and target that with like maybe community banks or certain clients that you have, or is that just completely off the table and it's nonsense?
So you're suggesting note brokering essentially?
What I'm suggesting is you go to a house in Aurora and you know that's vacant and they just started the foreclosure process, or maybe it's not vacant and you're, you know, whatever the case is, it's 3 or 4 or 6 months or 8 months away from going to the sheriff's sale and becoming an actual REO. And I believe you said you were actually doing inspection reports and a lot of this pre-foreclosure work, correct?
Right. Correct, yeah.
So could I come in to you and then we just basically submit, you know, to that client, hey, I am willing to pay, you know, 25, 30, whatever amount that I deem is fair and reasonable for me to offer to buy that note from the bank, and potentially you, I guess, making a commission or just presenting that offer in some way, shape, or form, facilitating that transaction with your REO clients that you already have? Or would they just basically shut that idea down and they're not even going to hear that?
It depends on which bank actually has ownership of the note. I have been able to do that before, where I had a property I was kind of keep my eye on, saw that I was able to buy the note. I made an offer prior to the auction itself, the sheriff's sale. I believe it was within a few days before it was actually going to sheriff's sale, and purchased the note, and then actually took the bank's position at the sheriff's sale as the bank. You know, it ended up going to REO. It was not purchased by another investor at the sale itself. But yeah, it's possible. It really depends on, I think the best bet's going to be your smaller more local community type banks to get access to something like that. I would say anything that's non-performing in a bank's books is ultimately something they do not want on them. So if you can target, or if I target a particular property or maybe a portfolio of notes, it's definitely possible to buy them prior to them going to REO and for lack of a better word, kind of cutting out the competition, because it won't make it through that sheriff's sale process unless you choose to do that, which is, again, each individual investor's goals are different. Just like you mentioned Dave Van Horn, I'm very familiar with him and what he does out there in the note world. He particularly likes to purchase second mortgages in addition to first and create a reperforming situation, so he's generating monthly income as a result. Each individual investor is going to have their own particular goal for what they want to do, but I have had situations where I have found a property that I'm interested in. I've contacted the bank knowing that it's in distress and ended up with, a 30-note portfolio on my laptop that I'm reviewing because they'd rather just dump off, the notes as opposed to dealing with that process and essentially tying their hands from lending additional money out there because they've got X number of, we'll call it, millions of dollars of bad debt on their books. And that's kind of where some of that power is in dealing in the non-performing note space as well, is that the banks do want to get rid of them. They do not want to take ownership. They don't want to pay a broker to sell it. They don't want to pay to preserve it. They don't want to fix the property. What's easiest for them is to make it go away. Just like any distressed seller in the real estate world or, the investment world, it just makes financial sense to stop the bleeding and move on. As far as, the larger Fannie, Freddie, HUD type situations, those are going to be things that are, essentially ending up in an REO portfolio or REO listing as a result of, insurance being insured as a Freddie or Fannie loan or an FHA loan. In those cases, they do sell prior to going to foreclosure, but they're typically in much, much larger packages and portfolios that are in the several $1 million range. So not something that I'm particularly focused on right now.
Got it. What kind of discounts have you seen? You kind of gave us some examples, but will it be reasonable, or is it basically a little bit of a crapshoot, just like when the REOs list? Sometimes you can have potentially a good deal, and other times they're listing high when you're doing the non-performing note purchase.
I've seen opportunities that were 50% of what that house's value was, and I've seen it as high as 90 to 95%, depending on the property itself and which bank it is. What's interesting about the note business is it's all a paper and numbers game. So the only boots on the ground they have is somebody like me who's going out to the property and taking a few exterior pictures and then giving them a valuation. Depending on who does that valuation, or maybe they hire an appraiser to go out there and walk the exterior of the property to get a better idea of the value, or they've got their original appraisal from when the property was purchased and the loan was originated. Their idea of value is not always what our idea of value is, as an investor. So depending on those factors, it is somewhat of a crapshoot, because sometimes you're going to have banks that just really want to dump off multiple notes or even just one or two notes for a discount because it's the end of the quarter and they want to make their numbers look good in a book. And a lot of times I see, as the note business has gotten more aggressive in the last year or two, as things start to stabilize out there, in the lending world, they're now at a point where they're looking for 80 to 95% of whatever that value is, which again can be challenging, but you just got to keep networking, talking to people, keep in touch with previous contacts. And, I'm a big believer in networking and just keeping in touch with people that I've worked with or want to work with. And, those opportunities do come up, but it's a job. It takes work. It's not something that just falls in your lap.
Sounds like everything else in real estate. Like I always thought early on in my career back in 2006, 7, 8. I thought, wow, if I could just get to the point where I could buy these notes from the bank, the world would be a much easier place to do deals in. Like, I thought it was going to be this silver bullet to get deals. You know, if there's one thing I've learned amongst many over the past 10 years or so is that there's no silver bullet. You got to make a lot of offers. You're going to get only a few of them accepted. And I guess what you're telling me is it's pretty much the same way in the note world, right, Joe?
I would say so, yeah. I mean, until you're working at a level that, you know, you may have access to large amounts of funds to purchase multiple notes or a portfolio of, let's say, 10 or 20 or 30 notes. I mean, it's going to be that way, yes.
Cool. Well, Joe, it looks like we're getting to a little past the top of the hour here. I got a couple more questions as we wrap up here. The first would be, do you have any book recommendations that I or our listeners should check out? Maybe one or two, you know, real estate, business, personal growth, something along those lines?
Yeah, as I mentioned earlier, maybe I have a short attention span. I'm not quite sure, but I'm an avid reader, preferably hard copy, not so much on the Kindle, but I also have one of those. And I'm always reading 2 or 3 books at once. Right now I'm reading a book by an accountant named Mark Kohler. The title of the book is The Tax and Legal Playbook, and it's essentially perfect. It's geared towards real estate investors, but it's essentially everything from start to finish on how to, or what the pitfalls and the pros are of what entity you want to create to do your real estate investing, how you can get some tax savings based on, you know, what election you take or what your business model looks like. It's a great read. I was able to read, you know, half the book in, you know, less than a day. Good information. I'm also currently reading a book called The Savvy Landlord by Stephen Van Cauwenberg. He's a guy out of Oklahoma. He owns about 80 rentals right now. I met him at a conference 2 months ago. It was like an advanced investors conference where we're basically sitting in a room of 40 guys and gals that each own somewhere between 100 and 500 properties apiece. It was an impressive group to be around. But that said, he handed me a copy, an audio version of a sample of his book, and I ended up listening to that, enjoying it, and buying it. I'm enjoying reading that right now. And then I always have a fallback of Think and Grow Rich by Napoleon Hill is always on my desk. I love that book. I love what it's about. I love the concept of what, you know, essentially Napoleon Hill did of interviewing and investigating, you know, mentors or people that had been successful in the business world. Because I believe that, you know, it all comes down to like who you surround yourself with is who you're going to essentially emulate and you know, turn yourself into. So for investors out there or listeners out there that are looking to, you know, improve their situation or get in the game or improve, you know, step up their game, go look at the guy who's right around the corner that you know is actively flipping or actively owning or buying and acquiring more property, and take him out to lunch, buy him a cup of coffee, start a conversation. And, you know, that can lead to friendships as well as, you know, mentoring opportunities where, you know, I feel like I would have been, you know, we'll go back to my original statement. That guy I met at the guy I met at the auction who was from Ohio. I mean, if I would have never met that guy and took him out to lunch, I feel pretty confident that I would have been a successful investor. But, you know, the REO business on my side essentially started because of that one contact.
Got it. So do you have any final jewels of wisdom you'd like to share with our listeners, Joe?
Yeah, I think I just said it.
I think
jumped
you did.
the gun, but emulate the people that you want to be like. Surround yourself with positive people that are actively in whatever business situation or lifestyle that you want to be a part of or you want to be like. Because they're going to ultimately teach you what it takes in order to become, you know, that type of a person.
Got it. So if anyone is interested in getting some more information about you or your company, would you like to share some contact information, Joe?
Yes. We do have a website, tanisgroupllc.com, and it's T as in Tom, A, N as in Nancy, I-S, groupllc.com. I'm also on Facebook, Joe Mueller and Tanis Group Realty. And we have a meetup group, which you can find us on meetup.com under Investor Empowerment Chicago, which is essentially, you know, my personal networking group where we're constantly, you know, evaluating deals and networking. That's where you and I met, Dan. I was at one of those meetings. And then email is probably the simplest way to get a hold of me, which is my first initial last name, J. Mueller, Mueller, at TanisGroupLLC.com.
Cool. Well, I appreciate you giving of your time so generously. I know you're busy, and I appreciate all the knowledge and experience you shared with me and the listeners here. I got tons of notes and tons of value, Joe. Thanks for coming on the show.
I appreciate the opportunity and really do appreciate the connection. And I know we're going to do some more business together, so I'm excited about what we can do.
You and I both, Joe. And thank you all for listening to this episode of the REI Diamonds podcast. Are you enjoying what you're hearing on these episodes? Maybe you know somebody else who'd also like to listen to this episode and this topic. You can always shoot them an email with the link and send them the information. You can also sign up to receive an email update of new weekly episodes at www.reidiamonds.com. And as a bonus for signing up, I'll send you my special report titled 7 Sources of Off-Market Deals. And you can also check out previous episodes. There's about 35 episodes posted there at that site. And we're also listed in the iTunes app. If you'd like to subscribe, just search REI Diamonds and click subscribe. Until next time, this is Dan Breslin, signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.